Happy Friday, everyone. Thanks for joining us today. Back in action with my co-host John and Jason and Isaiah from the Swan Private team. Welcome back to the show, gentlemen.
Good to be here. I say it every week, but I'm always wondering if the co-host title will be stripped at some point. I feel like it's kind of like a wrestler with a belt. You never know if they're just going to take it away from you or something.
I mean, Isaiah and Jason might be coming for it. You know,
I was gonna say that's why we're here, John. Oh, man.
Yeah, good to start the show off on a light-hearted note. I will just say right off the bat, if I have a more somber tone throughout the show, it's still a bit rattled from events of last week and weeks before that as well. So I will just say that if I do not seem like, not that I'm a super chipper person in general, but I don't seem like my normal self. Just wanted to throw that out there.
All right, that's cool. Thanks for sharing, man.
Absolutely.
How's it going, Jason?
Good over here, man.
You just signed up 2 vaults right before this call. 2 Swan vaults.
Couple of vaults. Yeah. Bitcoin's price is going up. People want multi-sig. It's the prime way to secure your Bitcoin. So it's a good thing.
Self-custody is the way.
Self-custody.
Yep. Isaiah, what's going on? What's the word on the grounds with the clients, the Bitcoin accumulators?
Yeah, I think I've had a couple conversations with new folks. It is a lot of conversations recently with next gen. Basically, like, I'm buying this for folks outside of me, which I think everyone on this kind of panel has had those similar conversations and or is doing that themselves. But that's what I've seen a lot of. And I can think of a couple, larger examples of that, which has been cool to see.
Nice. All right. So let's start with the Fed. We had a Fed rate cut this week, and 25 basis points. We also have a new Fed governor, and I've heard his name, like you said, John, before we started here, several ways. Miran. I'm gonna say Miran. I don't know. That sounds right to me. Let's take a look at Miran, and it'll show. Perhaps let's shed some light on why Trump nominated him.
You weren't just an outlier on the voting, but also on the dot plot, which we got. And we made a graphic of just how the dots look. Most of them expected either 1 more cut this year or 2 more cuts this year. And then there's an outlier, that bottom dot that wanted to see 5 cuts this year. Was that you?
That was me. And let me say something very clearly. This coming Monday, I'm going to be making a speech where I'm going to give a full accounting for my economic views and walk through in meticulous detail the economics and the arithmetic behind getting to those numbers. And it's too big for, people usually write these dissents, and the dissents are, like a page long, right? I'm going to walk through a lot of economics and a lot of arithmetic and a lot of math, and that's going to take a full speech to do. So we're going to get a full accounting of that.
There you go. Full accounting, big speech coming on Monday. It'll be interesting to hear what he's got to say, but lots of math, lots of numbers. It must have impressed Trump with that presentation to be appointed to the board. And it seems pretty clear to me that, Trump is more in line with the 5 rate cuts approach than he is with the more conservative 2 or 3 rate cuts approach.
He likes the dots. He likes the dots.
More blue dots. More blue dots, right? All right. Anybody have a reaction on his appointments and what we might expect from him, or just the rate cut in general? And we can also talk about this third mandate, which is kind of related to Miran too. That was his quote, wasn't it, John?
I think he's the one who said moderate long-term interest rates as a third mandate. Isaiah, how about you go first with your thoughts on this, and I'll fill in after.
Yeah. I mean, my thoughts were, it was obviously very telegraphed that we knew that we were going to get rate cuts. Typically, rate cuts are going to be bullish assets. We're going to go through a lot of different things today that will be fly in the face of that, as far as, the economy being weaker. The biggest thing, and we were talking about this before we went live, there was a commentator that I follow and someone that I've enjoyed his opinion for quite a while. And he kind of made the comment of, there's a lot of negative views of economic data, but maybe the worst of it is kind of behind us, and we're kind of coming out of that. And when you see jobs revision and all these different things, that rates should have been lower a while ago. And it's one of those things that's always funny. Like, we'll make jokes as Bitcoiners or here on the show, like, people setting the price of money and then like having the ability to think that they can control like how the economy should work in such a complex system is laughable. Like if we sit back and think about it. So I'm always a little bit of like, I'm going to stay on the left side of the bell curve and just be like, rate cuts good for Bitcoin. And that's kind of where I typically stand. And I don't try to overthink it too much. There is an interesting, I think, chart that will come up later that Brady has as well that talks about, with rate cuts, near all-time highs, like the S&P goes on to do significantly better. And I think that to me is really, really, telling. And I see asset prices being significantly higher, which truly is going to just exacerbate to me the wealth divide that we already see. But if you own Bitcoin, that is one of the things that can help insulate you from that. Typically, Bitcoin's going to do extremely well in those environments.
Yeah, I would say so. Like you said, Brady, they cut 1/4 of a point. Market seemed to have not reacted too much, which is not really that surprising to me. I was texting with a few friends and clients, and I kind of gave, going into the meeting, I kind of said, look, I think they're going to cut 25 basis points. That's what the market's pricing in. It just, given that my view, I think this is kind of obvious, but I'll call it my view, is that the Fed has been political for a long time. Are they getting incrementally more political? Probably, but let's not kid ourselves and pretend like they've been some independent, academic, pure organization prior to this year. Like, come on. But I don't think they have the ability or even the votes on the committee at this time to go like blatantly political and just say like cut rates 0.5% or anything like that. So that did bear out. They cut by 1/4. And unless crazy things are happening and they really want to signal something to the markets, the best bet in a Fed meeting when they're giving their talks, the actual words that they're saying about the rate cut action, is that those words will be hedged. They're going to say, well, we're seeing this in the economy and it points this direction, but we're also seeing this and we're trying to balance the risks and we're data dependent. And, next, we're not going to tell you what we're going to do at the next meeting. That's kind of their MO most of the time. And I just don't think there has been enough of a crazy, like the exceptions are crazy environments like during COVID and other things where they do have to signal a lot more clearly and forcefully, but we're not in any environment like that now. So I think taking it back, big picture, the market, I think, is battling out or figuring out which these two opposing forces are bigger. Rate cuts, all things equal, better for risk assets. But are they doing rate cuts because economic conditions have slowed? Is there a looming recession? Is the employment market much worse than we thought? And inflation, depending on how you measure it, is kind of sticky. Oh, they're cutting rates when inflation's sticky. So those are the two kind of forces battling things out. That's why I think you haven't seen risk assets just, pump easily, is because people are saying, hey, are we going to see harder economic times in the near term here? And maybe I don't want to be super long risk assets going into that because maybe there's going to be a better buying opportunity going forward.
Well said. Let's take a look at some of the, Jason, did you have something there?
Yeah, I was just going to add a short little bit. When I think about the dual mandate, you've got the unemployment side of it and you've got the inflation and price stability side of it. I think the inflation is higher than they want it to be, right? It's well above that 2% target, but the jobs numbers look so bad that when you think about, what is the cost? What is the economic cost of having that high of unemployment? They're not getting the tax receipts they otherwise would. And you have those numbers in tandem with rising prices. That's a really ugly combination. So the 25 bips cut makes sense to me. And I guess the more gradual approach to it with the further cuts makes sense in the sense that they're trying to kind of remedy that situation on the job side of it without hammering the inflation too hard. So
Yeah, well
that's
said.
kind of the quick connection I make there.
Yeah, well said. John, what's the sort of the meaning or the implications here? The third mandate. What are the first two mandates? We have the dual mandate, right? It's price stability and maximum employment. But now there's a mention of a third mandate to pursue moderate long-term interest rates, as cited by Donald Trump's pick for Fed Governor, Stephen Moran. The third mandate has sparked debate among analysts, some seeing it as a sign of that the administration intends to wield monetary policy to influence longer-term bond yields. The potential for the Treasury and Fed to intervene in the bond market to bring down long-dated interest rates has raised concerns about the risk of adverse effects, particularly inflation and the erosion of the Fed's independence. What does moderate long-term interest rates mean, and what are the implications here, John? If there is a third mandate, how could you see maybe an example of how you could see this changing course, for altering course or affecting decisions that the Fed makes?
Yeah, so I think this is like a soft admission or a small step towards some form of yield curve control. I don't think that's that crazy of a statement. It's like just kind of is what he's saying. Explicit yield curve control, just to level set, would be what happened post World War II or during World War II, where the government literally said, hey, the 10-year yield on US Treasuries is going to be this. The 30-year yield for long-term US Treasury is going to be this. We will buy as much in the market as we need to make that happen. That's like explicit yield curve control. Japan does similar things and has for many years. I'm not saying the US is going to do that anytime soon, because that really is letting the cat out of the bag. But I think you're seeing soft yield curve control with a statement like that, where he says moderate long-term interest rates. It leaves flexibility for what does moderate mean. Like, you just say long-term interest rates, doesn't really tell you what point of the curve it is going to be. So it's not full-on yield curve control, but it's certainly a step in that direction. And I think this is also consistent with, this has been phrased another way. You guys may have heard people say the third mandate, and people would argue the most important mandate is the stability of US Treasury markets, because every time that Treasury markets get illiquid, bid-ask spreads widen out, yields start to spike. We've seen it many, many times. 2023, during the banking crisis, we saw it start to happen, and it would have gotten so much worse, because if the government didn't step in with BTFP on a Sunday, then Silicon Valley Bank and other banks would have had to fire sale treasuries. Those markets would have went illiquid, yields would have spiked, and it would have been a disaster for the treasury market. Similar type of stuff in 2020, similar type of stuff in 2008. Whenever that starts to happen, the Fed steps in. So that is, I think, a pretty clear example that one of their top mandates, maybe their top mandate, is functioning of the US Treasury market. Now, what is the point of functioning of the US Treasury market? You could make some academic argument that, oh, it's because all these financial institutions have these assets, and there would be financial crises if yields spike, and it would be contagion. And I think that's all correct. But I think the less spoken functioning of the Treasury market's goal is the US government needs to be able to continue to borrow and continue to rack up debt, and to do it at a rate that is not going to put them into like a very clear debt spiral. I know people would say we're in a debt spiral already. It's a tough debate, because it depends what exactly do you mean by a spiral. But if interest rates rose enough, then it would become clear that it was like a really bad spiral, and they can't have that happen. So yeah, I think this is the world we're getting into. It's kind of things that Bitcoiners have been talking about for a long time. The gold community has been talking about for a long time. I still would caution people to be a little skeptical. This doesn't mean like treasury market's going to collapse. It doesn't mean the Fed's balance sheet is going to double, next month, or anyone making calls for that is probably still a little too extreme. The US going Venezuela, I'm not saying that type of stuff, but it is in the direction of continued dollar debasement. We can all debate the rate that it's going to happen, but like, this is dollar debasement. You're seeing it play out right now in real time.
John, I think your role as co-host is safe. That was excellent. So.
It was. That's why he's here. We've got all kinds of market data that we can take a look at today. It's a very interesting, perhaps, inflection point for the economy right now. Got everything's at all-time highs, right? Stocks, home prices, Bitcoin, gold, the money supply, national debt, CPI inflation, and the Fed's cutting interest rates tomorrow. In the midst of all of this, at or near all-time highs, obviously. So interesting situation. And let's just take a look at a few. I'm going to go through some data here, and then we can talk about it. This is There we go. This is CPI stuff here. And basically what this is saying is the Bureau of Labor Statistics is kind of estimating things more than they ever have, right? So in August, 36% of CPI prices were estimated, which was up from 32% in July and up from, here around 10% as a baseline for quite some time. So when, like, normally these calculations, they'll gather like 90,000 monthly price quotes across 200 different categories. And then whenever price data is missing, they fill the gaps with estimates, which usually make about 10%. So the share of estimates has rapidly surged over the last few months. So CPI numbers are becoming less accurate and less reflective of real consumer costs. And that's even more so on top of the fact that, CPI hasn't reflected necessarily actual consumer inflation or the prices that the people are dealing with. And we know that the CPI bucket, those goods that go into the CPI measurement, change over time, and administrations, they're not supposed to, but it happens. There's probably pressure on these independent government agencies to, adjust the bucket to, make the economy look like it's performing a little bit better, because it certainly is. It certainly does change. Here's some price changes on common goods and services that Americans consume. And that's obviously a lot higher than the 3 or 4% inflation that we've been looking at in the official CPI. So these are all important staples that are inflating much faster than the core CPI number. I'll pause right there. Actually, you can talk if anybody has comments on CPI. I would love to hear it. And then we'll go into the rest of these indicators that are interesting at this moment in time.
I think the big thing with CPI that always gets missed, and it's easy, and it took a while for me to really realize it, but it's always a stair step up. Even if they say inflation is cooling, right? It's still increasing. It's not really ever allowed to deflate and or go down typically. On the second chart that Charlie had, I think it's interesting to look at that. And the one that I think will continue to ratchet up and go, and one to watch, is you look at electricity. And electricity obviously up, 40% over the last 5 years. So, it's a healthy amount that it's been up. The demand for AI, I know this is something that's been coming up a lot in conversation with folks, of like the electricity prices are really starting to move in a different way. And it was funny that Bitcoin miners for so long were hated on, but now AI is here and AI is amazing. But you're seeing actually true electricity costs go higher. And you think about reshoring, you think about just the industry in the United States, electricity costs and the electricity consumption is massive. And that's one that will really, really start to impact individuals. And that's one that to me is noteworthy. Obviously, shelter, the way that the CPI calculates shelter is a little goofy. But yeah, we all know home prices have continued to escalate. Rates are significantly higher, maybe with some cuts, maybe with things that they come down. But I don't think the asset price corrects a ton, although I know you have an interesting chart to show later on that kind of highlights that as well. But yeah, CPI is always a stair step up, and it's slowing. But the fact that the mandates to Jason's point has been significantly higher to me is hyper noteworthy. And I don't think anything really stops this at the moment. And so what's fun to always do with those things is also price that in Bitcoin terms. And so what does that actually look if you net it out from a Bitcoin perspective? And priced in Bitcoin 21, which I think is back active from the URL. It was away for a little while. I think he or she has restarted it. It does a great job at pricing things in Bitcoin terms to show like, hey, in dollars, yeah, eggs went up this much, but in Bitcoin terms, it actually reduced. And I think that's always the way to frame Bitcoin to just normal people, right? People feel this. We understand things are going up in cost. Hey, did you know, actually, if you save for that big goal of like owning a house, it's not running further away from you. It's actually getting cheaper. Like that's super powerful. And when people bring up the idea of like, well, how do I, orange pill my friends or talk about Bitcoin with my friends? That's the easiest way that I always try to encourage people is bring it home and make it super easy to understand, because they get that. What are the things that they're trying to do? So those are my thoughts on CPI and inflation. And
I would just add, Brady, I think you did a good job saying how they have some like direct observations, but then they kind of like fill in the blanks.
Yep.
Just a reminder, anytime you're seeing, government data for sure, but probably most forms of data, sell imputation, and like price surveys, right? It's not as simple as them going to a store and like actually buying something and being like, this was the price of this thing. We've seen this with employment data as well. They publish jobs numbers saying, this is how many jobs were created. A person who doesn't dig into it would think they just counted up the number of jobs, like totally objective, right? It's not. There's a lot of assumptions of imputation, surveys, you know, who are you getting in these surveys? And there's a lot of room for honest error, but then there's a lot of room for dishonest manipulation.
Mhm.
So just keep that in mind with data like this. And yeah, what is Mark Twain? There's lies, damned lies, and statistics.
That's right.
So, you know, he said that probably over 100 years ago, and definitely still the case.
I just want to piggyback off of something Isaiah said about pricing these things in Bitcoin. I would agree that's the most powerful conversation to have with somebody who's not deep into this, right? Especially if you're talking about a home price, for example. 10 years ago, it would cost you hundreds of Bitcoins to purchase a home. Today, it's like, what, 4 to 6, depending on the type of home you're looking at. So I think that's a very powerful way to frame this. I also liked, I'm going to shout out a comment here in the chat. The hijacking of the definition of inflation by Keynesians really hides what's going on from the public. That's from Erica. I think that's a great way to put it. The CPI basket of goods and services is super, super opaque. There's substitution everywhere, right? If your ribeye goes up 30%, but your chicken breast goes up 4%, right? The logic there is, well, people will simply stop buying ribeyes and buy more chicken breast. And so we're going to put that into the basket and strip out ribeyes or weight it differently. And that's a really kind of easy way to manipulate those numbers. And so when you're talking to the average person about inflation, they're hearing that CPI number and they're accepting it as truth, right? The average person is not going to give you an answer if you ask them what the rate of inflation is. They're not going to give you an answer that's in line with the rate of monetary debasement. Like nobody's going to view it that way, right? The average person. So it's important to keep that framing in mind and kind of remind ourselves of that.
So I just looked up an article. I didn't find the site that I wanted to, but this is good enough. If you had bought Bitcoin instead of every new iPhone, assuming $999 price for every new iPhone, since the iPhone came out, you would have 2,250 Bitcoin by now, which is about $257.6 million, right? So that $1,000 went a long way. You maybe would have invested $12,000-$15,000 to get there. So pretty crazy. Same thing with homes. You know, like my home, I think we bought in 2008. Probably obviously at that point it would have cost me infinity Bitcoin, but let's say I bought it in 2012 or something, and probably it cost me thousands of Bitcoin, maybe tens of thousands of Bitcoins, right? Probably tens of thousands. Now it would probably cost me about 5 Bitcoin, you know? So it's pretty crazy. If you price everything in Bitcoin, there is no inflation. It's all deflation.
Since we're talking about houses, Brady, should we go to the thing about the boomers saying how much money they made off houses?
Yeah, here you go.
I'm thrown off here. Okay.
62% of boomer homeowners say they've gained more wealth from their homes than from their careers. Yeah. Did you want to take this one?
Yeah, and sorry if I'm throwing off the rhythm here, but I do want to take this one, and I want to propose something to you guys, which I did this week. So last week there's an investment banking conference in New York that I attended. Saylor spoke at it, and then this week I went to Tim Kotzman's and Ed Julien hosted this Bitcoin Treasury Unconference, I think is what they actually called it, but it was obviously all about Bitcoin treasuries, and Saylor spoke several times throughout the day, did a keynote, as did MSTR True North guys, tons of names that you would all recognize were speaking. And as usual in the crowds of these events, more so the one this week, got to speak to a lot of Bitcoiners who I am friends with, met some new people, and I bounced this idea off them, which is okay, let me start by prefacing and saying I consider myself a libertarian, limited government guy. I was literally reading anarcho-capitalist stuff on the Mises Institute in like 2008. So I'm kind of the last person that would be like, yay, let's have the government redistribute wealth. Now, with that said, if you're a Bitcoiner, and I think inherent in the Bitcoin thesis is that we believe asset owners, largely stocks and real estate, have benefited tremendously for the last 5, 10, 20, 50 years at the expense of people who've been left behind. You can look at this a million different ways. Home unaffordability, home price as a ratio to median income, medium wage priced in gold since 1971, on and on and on. Like you can just look at how working class people have been harmed, and non-asset owners, and asset owners have done phenomenally well. Even if you could snap your fingers and go to a sound money world, do you think that's the right thing to do, to say, hey, I know you guys have been screwed over for the last 50 years, but like, let's just, call it as it is now. People who bought a home for $100,000 and now the home is $900,000, they get their $900,000 home, but like, yay, sound money for now. You start saving up at this point in time. That doesn't really feel like a fair message to me. So where I'm going with this is basically saying, if you believe that, and I can't even believe I'm saying this for the record, but if you believe what that kind of showed, that there's boomers that have made more just by home appreciation than they have working their whole career. If that's the case, then like, what's the message to the 22-year-old kid who just graduated and doesn't have a chance to afford a home until he's like 30, 35, or 40? Like, isn't some sort of redistribution warranted? And before I drone on too long, I'm not saying every form of redistribution is right. Government run XYZ is often a terrible idea, but isn't there something that needs to happen to make up for 50 years of policies that have benefited asset owners? I think you're muted, Brady.
Muted, Brady. I think he's going to tell you, John, that you're going to lose your co-host spot.
Okay. No, actually, I'm going to tell you that I agree with you. And I have to play this clip. I was on Kaiser Report with Max Kaiser a long time ago at this point, and I shilled UBI to Max Kaiser. So we gotta watch this. It's 2 minutes. So there we go.
Developing over there. This sets up another interesting conflict, if you will, or generational conflict. So I would say that Bitcoin and hard money is certainly a respect for how capital forms the basis of a strong economy. Whereas we have another huge thread politically in America right now, which I think you could put under the heading of socialism. You've got modern monetary theory, or MMT, universal basic income, and a lot of other so-called left-wing agenda is strong. Yep. And that in Washington, you've got a whole bunch of politicians who are really hammering this idea that we need to start sending people checks every week. Is that another conflict? It's not generational in this regard. This conflict is more political. Do you find that political discussion going on, and how do you see that developing over the next few years?
Yeah, I feel like we're headed toward something like a universal basic income. That's over the past year, that idea has really gained a lot of traction. We're seeing it sort of tested now, trial balloons of these stimulus checks put out there, and I mean, honestly, I think that might be the best path to transitioning to a Bitcoin world, so that like you're putting some of the bad money out there as it's being printed and giving it directly to the people, instead of giving it directly to the big banks to lend out at low interest rates, and the whole Cantillon effect that we know well, and you've talked about many times in the show, and just give it to the people and let them buy Bitcoin, right? That might be the best way for us to move forward. So I would welcome a movement more toward a UBI type system. I think that'd be a fairer way to transition to a Bitcoin world.
Okay, I get it. So you're all for socialism as long as you can buy Bitcoin. Well, it makes perfect sense.
I mean, monetary socialism has been benefiting, the 1%, the 0.1% for so long.
Yeah.
That, toward the end of this collapse, might as well throw a little bit our way,
Yeah, fair enough. Now let's talk about.
And just to share the date on that, Brady. So that was March of 2021.
Yeah.
Just for anyone who was listening only. And that, Brady with Max Kaiser. I mean, I'll just say a couple of things, but I want to hear you guys. That's kind of where I'm at. And again, I can't stress enough that I am like limited government, states' rights. I think the American experiment is the best experiment in human history. Constitutional republic, federal government does as little as possible. But if we haven't been doing that for a long time, and the stimulus, which you guys were in this conversation in 2021, was a pretty good example of this. It was like, hey, we bailed out the system, like the financial market. So wealthy people's real estate went up 2x, their stocks went up 2x. But it was like, hey, average person who owns no assets, here's a $1,000 stimulus check. Like that, the people who had their homes and their stocks inflate tens of thousands, hundreds of thousands, millions of dollars in, because of the actions taken to save the system. And then it was like, hey, let's just give a little bit of a check. Like that was the temporary UBI. The word of caution I would say is, I don't think handing out money to people often ends well. A lot of people won't use it, and then they'll come complaining and saying, I need more. It usually doesn't, develop good habits and things like that. And I'm also very skeptical of the let's redistribute wealth by having the government run the healthcare system, the college system, the local grocery store. I think those are disasters. But at the same time, I feel like you have to do something to change, right the wrong that has benefited asset owners going back to at least 1971.
Yeah, I think my answer on that show was a little bit tongue in cheek, but I do mean that some corrective action would be warranted here, because monetary socialism has been in effect for 50 plus years at this point, maybe longer, since going back to the creation of the Fed, perhaps. And it's completely unfair. I mean, let's take a look at this here. I'm going to pull this chart up really quick. Let's see if I can find it. It is the wealth inequality chart. Is this it?
Yep.
No, it's not it.
The crossing of the lines.
Yeah. I'm not seeing it. It may have gotten something may have gone wrong there, but
and while you're finding it, Brady, I will just say part of the reason I wanted to bring it up is, look who's running for mayor in New York.
That's the joke I was going to make. I was going to say, John's been listening a little bit too much to Mamdani or whatever.
Yeah, I mean, I'm trying to explain why Mamdani exists.
Sure.
Yeah.
I'm just teasing. A couple different thoughts on my side, and Jason, I want to hear your thoughts too. So home appreciation leading to the most amount of wealth creation. I don't think it's as exciting if you dig into it a little bit. So a lot of California moved out here in the 80s or the 70s and bought the house, and now it's worth tons. Most people, again, being from the Midwest, right? The appreciation on homes isn't that much, and you have to actually net out a lot of stuff because these people aren't calculating also all the improvements and all the property taxes and all the things that go into it for actually a true rate of return. Now, and I think that's kind of damning to the statistic. And I think it's more damning on the fact that most of these folks, these boomers, didn't actually save a lick. They haven't saved enough. They actually didn't save any. They just spent everything they made and did a terrible job from a financial planning perspective. So this is the best thing that they've done, right? Because if you net it out and actually look at it from an investment standpoint, and I don't know who did the numbers and it's dated pre-COVID, but it was an average, if you looked at it nationally, and you could zoom in on certain areas, it's 3.8% was the annualized return on homes, typically, when you net out all the costs on side of that. So it's really not that great of an investment. But if you did nothing else, then sure. And the other thing that it's so what do you do for young people? And what do you here's my other take on that. So yes, print the money, give it to them, buy Bitcoin. I think that's fair. What about figuring out and solving for and stripping away regulation, allowing and knowing that younger people are going to leverage AI much more than their older counterparts, allow them to actually run and start businesses and give them actually a fighting chance to create value, and also strip away and give entrepreneurs an easier way to actually have health insurance for young families. Because right now people are so tied to a job they may hate because they have health insurance and they're too scared to leave it or find other options. There are other options. Shout out Crowd Health, no affiliate deal there, but just, I think that's a great option for folks that are doing that. Those are my thoughts outside of it. Not that I think that, the idea is completely wrong, but yeah, most people, if you give them money, it's give a mouse a cookie and they're going to want more. And they typically, you give them a ton of money and they're still going to fail miserably in life and you just wasted it. People that are going to be successful typically will be successful if they are given money or not. And that's the way that I look at it. And those are just a couple of my thoughts without being overly prepped, but that's a good thought experiment, John.
Yeah, I mean UBI. Idealistically, what I was saying on Kaiser Report is what I believe, right? And in the chat, Tifo Studios, pay the UBI in Bitcoin. That would help, right? In practice, it's not going to work out that way. But like morally speaking, it should happen that way. And let's take a look at this chart real quick that I wanted to share, but I had to pull it up on a screen share instead. The top 1% of U.S. earners now have more wealth than the middle class. And the middle class is defined as the cohort between the 20th and the 80th percentiles. So that's the middle 60% of Americans own the same amount of wealth as the top 1% of Americans at this point. And you can see the change from 1990, early 90s, where there was a much larger divergence, and it's now it's actually crossed. The 1% is now owns more than the middle 60%. And a lot of this is fiat money. A lot of this is inflation because they get the new dollars. They get the fresh dollars at lower prices than we do and have greater access to it. And what are they going to do with it? They shovel it straight into assets that are relatively scarce compared to the dollar, since it's lost its store of value function. So yeah, fiat money is definitely a part to play here. There's other things, that go into this equation, but I think the foundation of this chart is fiat money.
Yeah, and to be clear, I wasn't trying to say, I have the right solution here. It's more of a message of like, if we're all Bitcoiners, we do, I think by definition, believe that this system has benefited asset owners and harmed non-asset owners. So marrying that starting point with the fact that many, many people, particularly younger people, on both the left and the right, are very disenfranchised, feel financially hopeless, that I'm saying, I like Brady's words, some sort of corrective action does seem warranted. You could have endless debate over what that corrective action should be. And whatever you pick, some people will be very upset with you because you didn't go too far, you didn't go in the right direction. But it's just something I've been thinking about. I know, sorry to take the conversation in more of a social and political way, but this stuff is all very related to Bitcoin.
It's your prerogative as co-host, man. It's all good.
Jason, what's your thoughts? Because I want to hear what your thoughts are.
Yeah, too. You guys went pretty deep on all that, and I'm kind of digesting it. And I think in terms of like when you're getting that feedback from the boomer generation, you have to look at almost like this being in the right place at the right time kind of thing. And I'm not talking about the uber wealthy that owns multiple homes as an investment. I'm talking about the average baby boomer that says, I bought a house sometime post 1971, probably, right? And benefited from all of that post 1971 inflation. Most of that found the housing market, right? And I don't think there was, maybe not most of it found the housing market, but much of it did. And I don't think there was a lot of education needed there. I think you needed to buy a home to live, and you just kind of caught the tailwind benefit of owning that home. And I apply that framework to like, well, what if we gave millennials and Gen Z money and said, hey, go be smart with this? Would they find Bitcoin the same way that boomers found homes? Probably not, because you don't need Bitcoin. You don't explicitly need Bitcoin to survive day to day the way you need a home to survive day to day. So there's this part of my like visceral reaction. It's like, well, they just got lucky. I don't know that the broader population, if you gave them money and said, hey, go do something smart with this, that they would go, okay, Bitcoin, right? So there's like a very large education gap there. I definitely don't have the solution, but it's a really good thought exercise. It's a painstaking thought exercise to go through.
More data. We need more data. U.S. housing market has reached its most unaffordable level in history. This is a massive run up. And now that in the 2025 bubble, you can see up and to the right. This is striking, is it not, guys? That's home price on the left, the home price index. I'm not sure what home price index means. Unfortunately, I'll have to look it up here in a second while you guys are talking. However, you can see 2006, 2008 era. That was the other big bubble that burst and dropped us down. And then boom, right back up. Let's take a look at searches for help with mortgage. Now, reaching to the previous all-time high in 2008, starting to exceed it. Rental payments, late rental payments ticking up, the highest they've been since, this chart goes back to 2021, so the highest they've been since 2021. This is manufacturing. Sorry, one more here. Credit card debt. Searches for credit card debt have surpassed searches for credit card debt in 2008. Manufacturing jobs have been struggling for a couple of years, and this is the fourth consecutive monthly decline, which is the longest streak since the pandemic. So another piece of jobs data. This is the S&P 500 on the top here, the bar chart going up and to the right, and a divergence in middle of 2022, and this correlation completely broke down, and now job openings are about the same level as they were back in 2019, and way under where the S&P is. This is an interesting one. We'd love to talk about kind of ideas on why this chart might be happening, but we've also got this housing market bubble, people having trouble with their mortgage, people having trouble with making rental payments, people having trouble paying credit card debt, having trouble getting manufacturing jobs, and job openings are down. That's the data is painting an interesting picture here, guys.
Probably nothing.
At the same time, S&P's everything's near all-time highs, and we're cutting rates. So it's just very confusing. Are we going up? Are we going down? There's lots of calls for recession. Let me see this. We have, there we go. This is recession risk from Moody's Analytics is now up to 48%. And you can see once it gets to that level, there is usually a recession for some period. So we're at the threshold right now. So Moody's is saying there might be a recession. We've got all this kind of recession looking data, and we're pretty toppy and frothy in the asset markets.
To me, it just kind of feels like this has been kind of like describing the economy since 2008, to be honest with you. It's like at any given point, you could look at the economy and be like, there's a lot of issues here. Things, what different cohorts are not doing so well. Hey, the employment sector doesn't look so good. Like for most periods of time post the GFC, you could craft a narrative using these different metrics to say, hey, things are not looking so good here. The trickier part, or the part where I think some people go wrong, is they say, oh, there's going to be this recession, so like go into cash and like don't hold any assets. And that there's a good expression for this in traditional finance, which is trying to catch a falling knife. And that's not easy to do. And I think if you look at the government response to any sort of recession, weakness in the labor market, whatever it is, they're just quicker and quicker to respond with some sort of quote unquote stimulus, heavy quotes there, more like Band-Aids than duct tape. So if you just look at the markets for the last several years, it's like yes, there have been reversals, and you could do a whole interesting analysis of like, what have those reversals been? I think the two biggest ones to all be aware of in recent years was post 2021, the inflation that finally started to take hold. Their hand was kind of forced. They needed to have a year 2022 to get inflation back, the inflation rate, I should say, back down to more normal levels. And that did hurt risk assets big time. Another one was this tariff foray earlier this year. That was even more short-lived. But the takeaway is that, yes, bad things can happen to the economy. But I feel like if we've learned anything post 2008, it's that the response, the toleration for risk assets, particularly equities or real estate, to go down, there's just not much tolerance for that to happen. They're going to step in with something. So I would say, unless you have a thesis that something is going to happen and you're about to see a short-term buying opportunity, and when that happens, you better be quick to act. But absent that, you are better off being long stocks, being long gold, being long Bitcoin, being long real estate, because that, like you said, Bray, everything's at all-time highs. So you have to ask yourself, why is everything at all-time highs? And I think that starts to explain it.
What do you guys think?
I agree. I mean, the 2008, it was like it was a truckload of money that, from a bailout perspective. COVID, it was a now it's a garbage truck. The next one's going to be a squad of 18 wheelers. Like, it just gets bigger and bigger each time. And unless you're betting on everything ending and this being the final thing, which again, you can make the case that maybe they can't actually do it this time. Yeah, to John's point, it seems like that's the stupid thing to do, but yeah, there's also the saying, like, optimists make money and the pessimist is going to lose money. It's something where they will ensure that is a national security risk to have the S&P go down.
Mm-hmm.
I truly, truly believe that, because you can look at it with tax receipts. I know Lynn Alden's talked about that a number of times. If you look at the S&P and tax receipts, like, there's so many different things. They have to prop that up. And the amount of baby boomers that are requiring and need all that money to retire, like, they can't take this huge risk. It hurts any politician. There's no backbone to actually solve the issue. And it's always because of the way that the system is created. We're so short term, we can't actually, deal with the underlying issue. And at some point it will break and it won't be able to come back. I don't think we're there yet, even though it has felt that way. And you can take as many black pills and look how awful things are. It can likely last a lot longer. And it is one of those things where they are cutting rates. They're going to have to run it hot. There's no desire to cut entitlements. You want to be long risk assets, or it's just going to exacerbate the problem. And then you can look at consumer spending. And there's a really good chart that came out earlier this year where it was folks that make over $250 a year. It's 10% of the population, but it makes up over 50% of consumer spending. The upper part, similar to what you just showed with the 1%, like, that cohort is continuing to do better because they own the assets. But that also goes back to John's point of, like, at some point, and I think Jeff Booth's talked about this, you can't build walls high enough. At some point, you can't build walls high enough. There's going to be enough people that are down and out, and it does get to the point where it is not a great place. And there's a lot of, it can turn violent, and it will turn violent. And so, like, how do you solve all these things? And that's way bigger than Bitcoin. But I do think Bitcoin plays a role in that, and we all believe that as well. So
Yes.
it's hard to say what is the right answer. And it's going to be a combination of a lot of things, most likely.
Jason, any thoughts on that?
Yeah, I would agree that something like the S&P, it just can't stay down for any prolonged period of time, right? We're so reliant on the tax receipts from that. To Isaiah, I mean, I couldn't have framed it better than what Isaiah just said, honestly. Like John was saying about catching the falling knife, for example, like, you can think things will crash for a short period of time, and they sometimes do, but the reversal is pretty quick on that. The safest bet, I think, is to just be long assets all day.
And maybe don't take out a bunch of margin right now.
Yeah. Yes. Stay away from margin.
maybe not do that.
1x long Bitcoin. That's where it's at. All right. Let's talk treasury companies for just a little bit. We've been in interesting past month or so, a couple months in the treasury company space. The stock prices have just been taking a beating. What we've learned about these pipe unlocks, which where it was expected, but the Sequans pipe unlocked before any of the other big pipes, the private investment in public equity debt instrument, basically, to raise money to buy Bitcoin. And those pipe investors aren't always completely aligned. They with the kind of the long-term mission. They sort of they get in and get their money out and go into another pipe deal. And so when those shares unlock and they're able to be sold on the market, there's a dump, and it takes weeks to kind of churn through them so that new investors come in who have long-term belief in the strategy. And Sequans went through that, took a few weeks, and the stock is now moving back up. The bottom looks like it's in, and it's moving back up toward NAV, to a 1x NAV. It's still trading below the value of its Bitcoin. So it's at a discount there. And that's also happening with Nakamoto right now. Their pipe unlocked, and their pipe is a lot bigger than Sequans by like 3x. So there's a lot of shares to churn through there, and we'll see the same process. So it's been frustrating for a lot of investors, and I think things are turning around, and are more widely understood now after the Sequans sort of process was publicly made. So now that people are a little bit more aware who are investing in Naka, I think that probably helped people out. In any case, Corey, CEO of Swan, Corey Clipston, published this post today on Twitter. He published this image along with the post on Twitter, and he wrote this along with it. The returns of many investments, including Bitcoin, can be tranched into debt and equity, with lower risk reward for the debt tranche and higher risk reward for the equity tranche. Private funds have been selling this since at least 2018. Debt tranche gets about 12 to 15%, but if they withdraw when Bitcoin is down, then they get Bitcoin put to them. Equity tranche gets the levered upside above 12 to 15%. So you can create these tranches with a structured product, a fund, or a public company like MSTR. These tranche structures have already become a massive source of inflows to Bitcoin, and I think it's inevitable that they will grow tremendously from here. As with any new angle in markets, at the earliest stage, there will be a mix of good and bad projects, aligned and unaligned investors. It won't stay noisy like this. As the theme matures. All right, John, you wanted me to pull this one up and set it up for you, so take it away.
just wanted to chat a little bit about Bitcoin treasury, that whole world. Like you did a good job summarizing kind of the current state of sentiment, and mentioned a couple companies that hopefully people appreciate just having us talk about it a little bit. But I thought Corey's tweet was good because stepping back, bigger picture, even, MSTR, when did it really go on a tear? It was like kind of October, November, December of last year, I think. Hit whatever, $400 or $500 a share at some point. And it's kind of been chopping around sideways since then. But I think at that point in time, when it was first going up, it was like, there's going to be hundreds of Bitcoin treasury companies like pulling this off. And the sentiment was just absolutely crazy. Now it's like reversed to the point where I see some people, not all, but some people are like, oh, it's only MicroStrategy and maybe like one or two others. And that's it. And everyone pulling this off is a joke, and they're going to be bankrupt in 6 months or something. And I think both of those sentiments were too extreme in opposite directions. I think this is a case where the truth is in the middle. And I think there are going, and by the way, I don't think this is surprising either. This is like the messy process of an industry that's just coming around for the first time. A Bitcoin treasury company, a leveraged Bitcoin equity, a Bitcoin credit company like Saylor is kind of, I've seen him present twice now in the last 2 weeks, plus they did earnings recently. He's talking more like they're developing the Bitcoin credit yield curve, and they're developing all these instruments that credit investors can invest in and get some exposure to Bitcoin. So that, we're not even sure what to call these companies. Like every few months goes by and we're like, oh, maybe they're actually doing this. So we're really early in this whole story, and it's going to be messy, and we're not sure what the industry is going to look like a year from now, 3 years from now, but it's going to be an industry. There's going to be value in companies having a big pile of Bitcoin. And there's going to be a lot more than one company that is successful doing that. Now, just getting into Corey's post a little bit, he was basically pointing at the fact that there are investors out there that want Bitcoin exposure, but they don't want the spot Bitcoin exposure. So what Saylor has done is figured out how to say, let me slice and dice this Bitcoin exposure into different tranches or different packages, just to use more layman's terms. And there's other people out there that say, hey, I want a package that gives me this much yield, and it's ultimately comes from Bitcoin appreciation. But that's really it. I don't even want to know anything else about the Bitcoin. Other investors are going to say, I want this much yield, but if Bitcoin goes absolutely crazy and MicroStrategy goes up, then I want some of your equity. Others are going to say, I want this much yield, but it's going to be floating. in nature. So I don't know what the coupon's going to be. Others would say I want perpetual preferred, 8% for all time going forward. So he's basically meeting investors where they are, and funneling the capital from those investors into MicroStrategy, which means into Bitcoin. And I just like the way that Corey framed it, because it's not like, and it's in that sense, it's not even a brand new idea. Like the idea of taking an underlying investment and then slicing it up and tranching it and packaging it different ways has been happening for a long time. So that in that sense, it's not a new idea. It's just happening with Bitcoin. And I do believe it was inevitable. It's just that Saylor figured it out first and got to a scale where he could do it before anybody else could do it.
All right, guys, you want to weigh in on Bitcoin treasury companies, and then we'll wrap things up.
Yeah, I'll jump in. I think, the financial markets that Saylor is targeting with this, the debt market, the equity market, like it's massive, right? It's not like a winner takes all kind of game. So yeah, I would agree with what John said kind of at the outset there, that this doesn't have to be like it's only MicroStrategy because they were first. Obviously, they have a huge first mover advantage. They're ahead of everybody else, but there's so much room. There's hundreds of trillions of dollars in capital out there that can flow into this. MicroStrategy is not going to absorb all of that. And then on the other side of things, I don't think everybody, like, this isn't a get out of jail free card for every failing business that wants to pivot into this strategy, right? People are going to do it irresponsibly and fail. But I think there's a lot of room out there, and this is all super, super nascent and early. Some of the hype has faded out a little bit, and I think that's to be expected with just the fact that we've kind of been chopping sideways, even in the Bitcoin price for a while, right?
Yep.
Things feel a little less euphoric there, but we're not like on the other side of this by any means.
Yeah, agree. That was well said. It's not a get out of jail free card.
Yeah.
Yeah.
Nothing to add, Brady.
Use that line again. All right.
Nothing to add on my end. Back to
Well,
you.
guys, awesome. I'm going to wrap it up. Let's talk for a second about BTC in DC. This is happening just under 2 weeks, September 30th, October 1st, at the historic Kennedy Center in Washington, DC. This is hosted and organized by the George Washington University. We've been involved helping to support, and they've got a great team, and they're going to put on an absolutely incredible event. You've got Saylor who's going to be there. Aurelian Bortus is the organizer from GW. Jeff Booth, Adam Back, Senator Lummis, Corey Clipston, Samson Mao, Representative Warren Davidson, Pierre Richard, Tom Emmer, another rep. So obviously it's in DC, so politicians will be there speaking and sharing their ideas about Bitcoin. Parker Lewis, Mark Moss, Senator Wyden. Lots of great content. And in a great venue in an awesome city. So that is happening. If you'd like to go, if you're in the area or you'd like to fly out for this, you can register here and grab your tickets. It's going to be an awesome event. And check out Swan Private. All these guys are on the Swan Private squad, and they work really hard to build strong relationships with their clients. Let me share this tab instead. I'm talking about it. They work really hard to share strong relationships with clients, long-term relationships to build Bitcoin wealth, generational Bitcoin wealth. We've got a comprehensive wealth platform. These numbers need to be updated. It's actually close to $7 billion worth of Bitcoin now, purchased by almost 20,000 clients. So there's ironclad security and custody. And we have awesome events as well. There'll be a Swan Private event out in DC for BTC in DC, actually. We also have an IRA product, Bitcoin IRA. It's more than a plan. We, again, partner with you here and try to help you figure things out so that you can put together a great plan to build Bitcoin wealth. You can come here and play with this cool calculator, set all of your assumptions down here that you're comfortable with, and see how Bitcoin can help your IRA performance. And also Swan Vault. We started out the show talking about Swan Vaults. Gosh, I keep doing this. I need to change tabs. Here's the calculator I was talking about. It's a lot of fun to play with. Check that out. We also have Swan Vault. And we started the episode talking about this, that Jason had a couple of calls about Swan Vault. getting clients set up with self-custody. This is an advanced Bitcoin cold storage system. It's multi-signature, meaning you need 2 out of 3 keys to move your Bitcoin. And this is collaborative in the sense that you are in full control of your Bitcoin, but you don't have to go it alone. Swan is there to help you. You have a cloud key as part of your Swan account that you can use as a convenient signer for transactions. So you have your one hardware wallet at home, your signing device, and you sign with your cloud key to send transactions. It's really convenient. But you also have complete full control because you have your second signing device or hardware wallet. And you can always send your Bitcoin with those 2 without having to interface with Swan whatsoever. So I think it's a really great solution for a lot of people who own Bitcoin. You don't have to, be very technical to use Swan Vault, but it does provide a very high level of technical security. So if you're interested in Swan Vaults or in Swan IRA or in Swan Private services, get in touch with us. Just click this Meet With Us button, and one of the guys from the Swan Private team, maybe Jason, maybe Isaiah, maybe John, will get in touch with you and help you get started on your way. So thanks, everyone. Shout out to Mara as well for supporting the show and securing the Bitcoin network. We appreciate it.